5, 4, 3, 2, 1.
Well, thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Brokerages seem to have made the most of FY21, if you will. And one of the leading brokerages, ICICI Securities, is no different. Their Q4 numbers were pretty impressive. There was strong traction on the retail brokerage revenues despite the change in the margin norms and the resultant impact thereof. Plus, the client additions, as their presentation shows, is the highest that they would have done in any quarter by a country mile. Let's get in Vijay Chandok to talk about some of the nuances of the quarter. Vijay, good having you. Thanks so much for joining in. Congratulations on the strong quarter. I would probably believe that the highlight is the kind of client additions that you've done. Tell us a bit about it. I'm guessing online onboarding of the clients would have had a large role to play in this.
Thank you very much, Neeraj, and thank you for having me on this show. Indeed, this quarter we added about close to 3.5 lakh customers, and that is a record for ICICI Direct. I have been saying to all of you in the past as well that we've embarked on two very specific areas to focus on. One is to go digital and acquisition. I think that's been a very, very important lever we've pressed beginning of this year. Second is to go open architecture. Both these pivots, to our mind, are very important because when I say go open architecture, it means that a customer need not necessarily be an ICICI Bank customer to become an ICICI Direct customer. And that automatically throws open a very large market opportunity for us. For almost 20 years, we focused on every customer needing to be an ICICI Bank customer, which restricts us to actually just about 10% of the market, Indian market or so. So suddenly 90% of Indian market is now accessible to us in a sense through that pivot. Digital is a new way of acquiring customers for the company. So there has been a learning curve that we have gone through. And I would say we are still going through as we speak. And some of the elements of this digital sourcing, some of the components of this open architecture, the communication, etc., that we've been doing systematically to the customers is probably all coming together. And that is what has led to a increase in the customer acquisition at a much higher pace than the past quarters.
Yeah. So two questions rolled into one, Vijay. One, for a lot of people, FY21 was an aberration that, okay, because people are at home, they will do trading, and therefore brokerages might see higher client additions in the first 2 or 3 quarters, and then it will start ebbing. Would you believe to the contrary? Would you believe that FY22 can see continuation of this pace? And part 2 of my question is there, I'm guessing there is, but I would want you to define it maybe, that the difference in the profitability metric of the clients who is coming in on the discount broking or the lower brokerage model versus your normal clients, if you will?
Yeah. So, let me try and answer this question the way we think. We are here for the as a firm. Our strategy is not a quarter or a year strategy. Our strategy is something that we are pursuing because we passionately and strongly believe in the story of India. And the opportunity of financialization that is waiting to happen. It is going to happen. There could be a few quarters of blips here and there as markets to have. But I think this long-term story, medium-term story is pretty intact, pretty strong. Our objective is to watch trends. Our objective is to stay committed to that medium-term opportunity, and then position the company to take advantage of that in the manner that it works well from a customer relatability point of view. So make things which are relatable to the customers as time is progressing, and pursue the opportunity of financialization that's there in the market. So it's purely with that objective we positioned the company last year, and we just happened to get a big tailwind which led to a big surge in FY20. We are continuing to sharpen that element, and therefore to me, beyond the point whether 2021 is going to be a great year or not a great year in terms of opportunity for the market is something that will play out. But I think I'm pretty certain that if you were to look back within 2-3 years from now and look back, I think you would be at a far higher platform than you are at the end of 2021. That's how we are looking at. And what is important is that we pursue it in an efficient way. What is important is we pursue it in a manner that the customer continues to remain happy, because that is the key in for us.
Sure.
The second element of sorry.
No, please carry on.
Yeah, you also asked something on the discount broker, so I was just moving to that.
No, I was wondering if you believe that if profitability and client acquisition and the client numbers were growing in a particular correlation up till now, will that correlation stay, or do you reckon that the profitability may dip a little bit just because one, the pace of the client acquisition is just so strong, or two, that the profitability per client will also come off a little bit?
Yeah. So, we certainly believe that it's important to diversify because to your point, one should expect yields to become, weaker in the sense at a per product level. The only way to offset that and get an aggregated higher revenue is two ways. One is you grow at a faster pace than the decline in yield, and two is that you add more revenue pools that are more sustainable, so that you are not dependent on a single product. These are the two philosophies that we have sort of chosen and very assiduously implementing. If you see, it's no longer about only broking. It's no longer only about mutual fund. We've added a slew of products. In fact, customers can select some 50 products from our platform. We've gone open architecture on health insurance. So this year, for instance, we saw a big leg up, apart from equities, of course, on the fixed income side. A lot of people went and picked up sovereign gold bonds, RBI bonds. It was a pull. There was a big surge there. Fixed income instruments saw a big surge. We saw a big pickup in terms of health insurance policies in the context. So it's about ARPUs which are coming from a customer and not from a specific product segment, which is the look. This year we've seen very good traction when it comes to equities, specifically. But the fact that you're growing at a certain clip, which we believe is going to continue this year, and the fact that you're diversifying and deepening and digitizing even non-equity products to be delivered to customers will give us an opportunity to get revenue not only from equities and few other products that are digitized, but more and more products that are digitized. So our effort is to offset whatever product level yield decline or volume decline that may set in the natural course of a business cycle, is getting minimized, offset, and ideally, completely offset by some other element of the opportunity which is growing. It could be loan, it could be insurance, it could be fixed income, it could be a PMS solution, it could be some other form of a trading style equity, or it could be a specific strategy in equities that we have. Yeah. So that's how we are looking at.
Okay, that's interesting. And I would so even if you have to set up specialized teams for the same, and even if the yields come off, you would reckon that you would, in your all earnestness, through cross-selling, try and maintain or maximize the revenue per client, so to say.
Yeah. So if you look at our ARPUs last year, it is increased by about 16% on a YOY basis. So this is, mind you, on the back of huge growth in customers. So our customer growth, active customer growth has been close to some 48%. So on top of a 48% growth, there's been a 16% growth in ARPU. So it is a reflection of implementation and execution of the strategy.
And what's the yield come off by, if you will? Has it come off?
So honestly, if you're referring to yield, you're probably referring to equity yields. While I don't look at it in a razor sort of a sharp manner, because I have realized that if you become too focused on a specific product yield, it in a way limits you from thinking more freely from a customer's point of view. And I don't want to be caught on that. So I look at it, but I don't get sort of overswayed by it. It has come off, but I think on an aggregate basis, more customers have come in, more volumes has come in from that customer. And we want our customers to be happy, because the life cycle value that I can monetize from a happy customer is far higher than that delta yield that I will get on a specific transaction.
Okay. And my last question will be on that. But before that, some numbers on the broking side, Vijay. Your retail brokerage revenues went up, and which the street was happily, positively surprised by. The market shares, I think, both on equity as well as equity derivatives has come off. And I think everybody's looking to September, wherein this final norm implementation will be out as well. Will that have, or could that have, a telling impact on how the retail brokerage side of the business shapes up in FY22?
Indeed. I don't think the retail brokerage side of the business will be independent of what's happening to the market.
Right.
It will have a linkage with the implementation of these norms. And we have seen two things. One is when round 1 got implemented, market impact was minimal. Round 2, we saw some impact. 19% ADTOs actually came off in the market. But I have seen that, whenever there has been a new regulatory norm from the implemented, brought in by the regulators, there is always a transient dip before eventually markets resume its growth. That's the kind of behavior we have seen. There have been a number, and I've seen it over the last 10 years. I've gone back into time just to see what happens when various interventions are made by the regulator. I think it's fair to say that when you look back, you two things come out. One is, it always leads to an orderly growth of the market. The riffraff and the fluff in the market sort of gets taken away, and a more robust and a sustainable element of growth stays back, and that's what sort of comes in and gives you stability. So it's a more orderly growth, point number 1. And point number 2, after the transient sort of decline, it eventually resumes. And for example, equity derivatives is already at a higher level than pre-November levels. This is despite the implementation of round 1 and round 2. Month on month, it has dipped. But November to, let's say, March, the numbers are at the same level. What it means is that what dip happened on account of the implementation of the norm took 3-4 months, and it is now gone. The natural growth has once again returned. Probably had these norms not been there, the growth would have been at a faster pace. But the fact is that the growth resumes, but it's on a far more solid footing than it was in the past.
You're saying that dip happened in December, but it's kind of getting digested in the quarter.
Exactly. It's already in the month of March on equities. The numbers are already in a way digested compared to November. So November to March numbers are similar, though February is higher than March.
Got it.
So that dip, but it still goes back. So to that extent, in that context, to your point, the 2 other guidelines that are going to come, I would expect a similar situation to play out in round 3 and round 4. There would be an impact in the market in the transient period, and eventually the market forces, the opportunity in the market that's being pursued by the young millennials, the Gen Zs, I think should continue. Greater financialization is there to stay, and it takes a few quarters, few months, depending on what it is, and then picks up. So I would say that there would be these couple of headwinds to maneuver as we are moving into the new fiscal year, and there are various ways we are doing to counter it. On the derivative side, actually, we have unleashed a new plan for traders called Neo, which is the most attractive plan actually in the marketplace, where the pricing, which is important for traders, is one of the best in the market. 20-20-0. So 0 on futures, 20 rupees on options, and 20 rupees on intraday. It's the most competitive plan that exists in the market. And we are seeing some very good traction. We are augmenting the plan with a lot of tools, do-it-yourself tools. These are just gotten integrated few, I would say, days back, and they are getting sort of sharpened on our app and implemented as well on our app, which we feel that a combination of a great plan and great tools backed by research, and the stability of the brand and the institution backed comfort that we can offer to the customer, I think we have a winning proposition. A great plan, competitive plan. You have the support of an institution to give you that comfort, and the UI UX, the experience has to be good. The tools have to be cutting edge and contemporary. Some work is required to be done there. I think once all these things start coming together, in the more, I would say, matter of a few quarters, the impact of all this should play out in the market. And that's what is our approach with respect to the new norms that are coming in.
Okay. So then final question, Vijay. Quarter 4 saw a fairly decent uptick on the revenue side. I think you probably grew your revenues by about 53% by growth across all businesses without exception. How do you expect, now that you have had an FY21 which has been rather strong, and therefore the base effect isn't necessarily in your favor, so to say, how do you expect FY22 over FY21 on the back of a few things that you mentioned? If indeed Neo is so good, and if it is onboarding clients successfully, then if not for quarter 4, at least for quarter 1, quarter 2, quarter 3, you do have a bit of a base effect positives as well. What kind of growth, revenues, profitability do you expect FY22 or FY21? You don't look at business quarter to quarter, but surely you can give us some sense of what the year could be like.
So, we had a huge debate around the same subject, and we concluded as a team to remain optimistic about the year forward, despite the realities of the points that you said, that we had a great last year. The base effect is no longer going to be there, and in our internal planning and our internal execution game plan that we have unleashed and rolled out in the company, we are going for a growth on top of this. It is quite bold, but that's the way we are thinking about it at this point in time. But that's an internal plan, I must hasten to add. So our approach is therefore to identify. We are expecting headwinds in certain elements of the business, but we are also expecting tailwinds in certain other elements of the business. And some of the other elements of the business we believe would be similar to last year and not really get impacted despite having a great last year. So that's the way we have sort of stacked up different components of our business as to which will be more impacted, which will actually be a beneficiary, and which will be somewhat impacted, but with effort you can make up and still show a growth. And that is the kind of resourcing, that is the kind of planning, that is the kind of investment of people's time is being pushed at. So on an aggregate basis, we are planning for a growth.
Okay. Well, we wish you all the best for that, Vijay. But congratulations on a good quarter, and all the best for the quarters ahead.
Thank you so much for having me once again. Always a pleasure to talk to you.
Likewise. Great having you. And viewers, thanks for tuning into this edition of The Talking Point.